That's a nice vest, though.
Yeah.
Close that other zipper. I don't like that one zipper that's open.
Jesus, it is. It's all closed.
No, the one, there you go. Now you're closed up. I mean, zip it up, bro. Zip it up. All right, ladies and gentlemen, welcome to another episode of Rein It In. Today, Patrick, I got 6 different topics in front of me. And of course, we're going to interject a variety of other topics, but the topics are as follows. Number 1, interest rates. The Bank of Canada finally increasing 0.25%. We were finally right. Actually, most of the market was right. That's surprising. Interest rates is number 1. Inflation is number 2. It appears to be slowing. Is it really? We're going to find out. Number 3, the impending recession. What's happening with that? We're going to talk about the recession. Immigration, record immigration for certain provinces. What's it doing in the real estate market? We're going to talk about that. I got to take a breath. We're going to talk about a lot of things. Commercial vacancy at really a low point, and some serious creating some serious ripple effects in the real estate market. And the last and final is some of the GTA and Toronto speculators are finally getting washed out of the market, which is exactly what we predicted 6 months ago, Patrick. It is coming to fruition now. That's what we're going to talk about on today's episode of Rein It In.
Well, let's get going.
Okay, first topic, interest rates. Finally, the Bank of Canada does something sensible and only increase 0.25%. I guess I've just become accustomed to these like 0.75 and 1% jump. So I'm thinking 0.25% is great now. Oh boy. But anyways, Patrick, the market, I think by most consensus called a 0.25. You called a 0.25. I was hoping for a 1% decrease in interest rates only because I'm a contrarian. I got a bunch of mortgages coming up for renewal. What are your thoughts on the Bank of Canada's take only increasing 0.25%? What does it say to the market?
Well, I think it was sensible for them to do. And as Tiff pointed out in his narrative afterwards in the press conference, he answered some questions, but he really said, we're going to take a pause. He really set it up to give people confidence that, moving forward, they're going to be paying attention. They're not going to be necessarily arbitrarily raising rates. They're right now looking at pause. They're going to watch the market. They're going to watch the indicators before they, raise rates again and before they consider it. So it was more of a responsible way to present it. As well, it showed some optimism by the Bank of Canada of what's happening economically. So what do we see going forward? Will they pause and will they continue to pause? I mean, there's some data that we're going to have to keep an eye on. We can talk about that shortly. But they're going to be looking at the data going forward and then deciding whether they're going to increase or not. Some are actually, JG, calling for an increase or a decrease by the end of this year. I know Bloomberg's one of those groups that are saying, something by the end of the year, we could actually see a decrease in interest rates. I'm not that optimistic. But having said that, I think the Bank of Canada did the responsible thing. They could have gone without the 0.25%, I believe. But let's put it this way. What they're going to do is they said, we've raised it that 0.25 point. We're going to sit and wait and watch what unfolds. Let the lag catch up. And that's what needs to happen rather than just continue to raise rates. They've already done record increases in terms of the time frame and the amount. So this was the responsible thing to do. I'm finally agreeing with Tiff. Although I still think he should have been fired a long time ago.
Your opinion hasn't changed. Here's what I'd say, Patrick, which is I'm sensing this right now in the market. I think it's very interesting they did this. I think it's a good thing they did this, only 0.25. I would have loved for them to at least do nothing, and that would have been even better if they would have paused. I've seen a significant change in the marketplace so far this year in 2023, Patrick. I'm seeing people now accustomed to this new reality. And I find that, yes, certain industries are really feeling it. And we'll talk about that in a second. But the majority of people are like, okay, this is the reality. This is what we're dealing with. And now things are getting a little bit back to, let's call it the new normal. Hate that term because of, it was created during COVID. But the new normal is these interest rates are going to be around for a little bit and people are settling into that. Now, I'll give you an anecdotal story of how I see this happening is, I got a colleague of mine who's got a house for sale, just a house, single family, nothing crazy, in the 700s around Peterborough, relatively normal. He had more showings in last week than he's had since August. Between August and the end of the year, He had so few showings that he had more showings last week. And this has actually been increasing since the beginning of January. That's what I mean about the market. It's the same with our showings in terms of our rentals and our portfolio that we manage, Patrick, across $40 million of real estate. We see a lot of different trends. Yeah. We're seeing things getting back to somewhat normal. People out of the panic phase. I think that's a good thing because it's going to help confidence. That's my take.
Well, yeah, I think I see those points, and I think we need to just go down a little bit deeper. Number one, mortgage brokers are saying that they've been very busy recently, but we have to look at a couple things. We're talking about Bank of Canada rate, which really affects the variable rate mortgages. What we've seen, though, is bond yields change. And so now we're seeing mortgage rates that are, just over 4%, which we've normalized now. And more importantly, people, if you listen to the brokers, the mortgage brokers, what they're saying is people are now coming in for mortgages for under $1 million as opposed to over $1 million. So there's this balance that's started to happen in that regard, as some prices have come down in some regions. And of course, with the fixed rate being, under 5%, it really opens up the door for people to consider that they can afford this. And they're taking short term because they anticipate rates coming down in the future. So, those are calls that are being made. But to your point, what's happening is we're starting to see some churn in the real estate market that way.
And that's nothing but good things. Will help confidence, will help the market get back to a new version of equilibrium. As we talked, Patrick, you and I were talking this week at various dinners we had and events we were speaking at. And, the economy is a delicate equilibrium. I mean, there's ripple effects throughout the economy. And now that things are getting back to normal, things will fall back into equilibrium. And this will be nothing but good things for the market as people go forward and market. And I'm going to be curious to see what happens to the spring real estate market, because we're really kind of we're getting close to it now. We're entering February. We're going to be in March. We're now into the spring market. We'll see what it does. I'm very curious.
Yeah. And the only thing to add to all of this is we have to remember one fundamental thing. There's a lot of moving parts in an economy. And as much as we focus on real estate, we have to look at all of the things that are impacting the real estate market, impacting our economy. And that's what we have to pay attention to. Now, that's what the Bank of Canada will be watching, and we're going to talk about those data points shortly.
Interest rates covered. I love it. This is one for the books. That was a good shot, eh?
Almost hit me.
All right, Patrick, now we got to talk about inflation. My gosh, I feel like a broken record around this stupid topic. I hate talking about it because I feel like a broken record, but it is important. It's on everyone's mind. So let's talk about inflation, because finally we're starting to see some numbers come back. And is inflation, in fact, starting to taper? With thoughts on this, and let's get into it.
Well, this is what, the raising of rates is all about. When we look at interest rates, they're trying to tame CPI. And when we're looking at inflation, but the thing that we consider when looking at inflation is we have to look at a lot of different parts of and what makes up inflation. Now, the good news around something is that energy costs have come down, which means that fuel costs have come down, transportation costs have come down. We've seen China come back online. So a lot of the goods that were hung up over there or sitting in the middle of the ocean or wherever they were, they're starting to flow through. So the costs of transportation are coming down in general, which is bringing the cost of some goods down. Hasn't really impacted food per se, but we have seen our fuel costs come down. Now, these are things that drive our inflation overall. So Bank of Canada will take credit for the interest rates having an impact, and we won't even debate that point. I don't agree totally with it, of course. What's interesting also about CPI is shelter costs make up a big part of CPI. I don't remember what the weight is, and it's a little bit convoluted anyways. But the point is that as shelter costs go up, what's driving shelter costs is the interest paid on a house, for example. So, he's increasing rates, and I get it. They're increasing rates, which is supposed to bring CPI down, but they're increasing rates, which is impacting shelter costs, which is part of what drives CPI up. So it's just this kind of weird counterintuitive thing that's happening that I like to point out, because a lot of people just aren't aware of it. So I think it's interesting to see what happens with interest rates and against shelter costs. Of course, rents have seemed to have topped in most regions, but rents have also kind of, as we shared in the last one, Rein It In, JG, we see rents go up with interest rates. Now, it'll be interesting to see if we see rents bump up a little bit, given this quarter point increase, or are rents going to get it flattened out?
Well, I think, and this is back to the conversation we often have about the economy being a delicate equilibrium, because rents can only go up so much. They have to go up. They have to follow the price of housing, but they can only go up so much. I mean, people can only afford so much rent until they say, listen, I just can't afford this. And landlords understand that. Rental housing providers understand that. So there's definitely a balance there. And we called this top in rents, Patrick. I remember a couple months ago saying to you, listen, I'm seeing that we're at the top of the rental increase right now. And sure enough, now the data is showing that. And when you're in the trenches and you manage enough properties and you see enough of this stuff, you can kind of see these trends developing way before they actually develop. And inflation is a good example of that, how, it is coming down, which is good from that perspective. But also we got to keep in mind, Patrick, inflation is a number that is and it's measured as a percentage of last year. So yes, we are getting, a 5% or 5.5% inflation, or whatever the number is, but that's on top of last year's 7%. So the increases are decreasing. The cost of living is still rising, and there's no doubt. And I want to come back to where you started, which is there's no doubt the Bank of Canada are going to look like heroes around this. And I told you that right from the very beginning, that they always put themselves in a position to look like heroes, even though it probably had not that much to do with interest rates, had a lot more to do with the supply chain. They will still appear like heroes. That's just the way the system's designed, Patrick. Pisses you off, but it's true nonetheless.
It does. So there's a couple things that we need to point out. Let's shine a light on a couple things. So when we look at what's happening in the economy and inflation, we look at rents. There's a fundamental that we don't want to step over. Back to a little bit about interest rates. Something that the Bank of Canada has to consider is the enormous amount of debt that Canadians took on when they borrowed all of that money on their lines of credit. That has an impact on the economy. So when we get into the inflation world, what's starting to happen as well is people are not spending as much money. They don't have as much money to spend. Their interest costs alone have gone up, let alone their food, fuel, et cetera, and their rents. So that's all part of what will slow an economy down as well. The thing is that savings accounts have also gone up, but not for everybody. This again goes back to speaking to who does inflation really affect. And it affects primarily the lower 50 or 40% of the population, the slightly lower income or even low income families that are trying to deal with these rising costs. Now, on the other side of it, the top 50%, if those are the numbers, and I'm just kind of throwing some numbers out there, ultimately the cost of inflation annoys them, but it doesn't shut them down. They're maybe spending a little bit less, but not as much. So the point of it is that these are the things that happen when we raise rates. We've got high debt right across the board on lines of credit, as an example, renovated houses, boats, cars, all the things that people spent money on. So this is all part of what drives the inflation or slows it down. So there's some argument saying that people are spending less, that will slow an economy down.
Now, and this is actually showing up, Patrick, in the GDP numbers and the forecast that we're seeing. We got this chart here on the 2020 to 2030 GDP per capita for G7 countries. You see Canada is down at the bottom at 0.7% growth over the course of that's percent per annum. But this is where that shows up. So in case people are asking themselves, how does this show up? How does increasing interest rates this much show up? It shows up in the GDP numbers, and a 0.7% growth, Patrick, is pretty damn close to zero, and anything less than zero for 2 quarters in a row is considered a recession. Now we can talk about whether or not we think we're going to have a recession, but that is what a recession is technically considered. And I tell you, Canada is at 0.7% forecasted growth. That's a forecast. It could change, but we're getting close to that 0% mark, which is always a little trepidatious, because if we go down below that and people start labeling this as a recession, it really hits consumer confidence and it really hits people. Then they really tighten up the wallets because we're in a recession.
Yeah, there's a couple things to say about that. That particular chart was from OECD, I believe. So, Tiff Macklem is actually forecasting over 1% growth in 2023. And then I think they go into 2024 with 2% or something along that line. But the OECD is not as optimistic about Canada as Tiff Macklem was. So we'll see what happens with those numbers. These are all forecasts, of course. And this is where, we as REIN want to be looking at these numbers all the time and sharing them with the community and sharing them with our viewers. because this is so important to understand, is that the Bank of Canada is going to be looking at a lot of different data. That's the same data that we're watching, so that we can anticipate where the market is going. As real estate investors, that's part of what we have to look at. So back to the GDP conversation, is some regions of Canada, particularly Ontario, will feel the effects more than, let's say, the western end of the country, where we're seeing as we've said many times, Alberta, Saskatchewan, Manitoba will be much stronger, particularly Alberta, in terms of their growth. So it's all to say, we've got to think regionally as real estate investors, pay attention to the GDP numbers, and we're going to talk about it. We have to pay attention to employment and looking what's going on with those numbers.
Inflation covered,
handled. Oof. Oh, geez, you almost got me again.
Almost hit you right in the forehead there, Patrick. Watch it next
There's
time.
There's a lot of forehead there. There's a ton of forehead. You could have really.
It's not, a big target. It's not a very difficult target to hit. I'll tell you that.
Okay, settle down.
Let me try it again. Oh, right on. Boom, just nailed it. I'm on fire today. Look, I just keep nailing the camera.
You just got it handled. Okay, let's go.
All right, Mr. Alberta. I know you've been dying to, you and I you were on a podcast this week. I was your arm candy, and then you were speaking at a different event. And I tell you, this Mr. Alberta thing is really starting to catch on, Patrick, because other people are starting to call you Mr. Alberta because they see your your positive lean towards Alberta. So I'm opening the conversation by talking. The next topic is recession. So I'm opening the conversation, Mr. Alberta, and I'll just leave you the floor, and then I'll see what I can do with it.
Okay, well, I'm Mr. Alberta only because we look at the economic fundamentals, and as much as I am a fan of Alberta, I was born and raised in Alberta. The point is I'm not attached to Alberta when it comes to what's happening economically. As somebody who's looking at the economic shifts that are happening, and as a real estate investor, I just want to put our money to work, or my money to work, and I want to put it into an economy with a future. So, as you recall, back pre-COVID, we were talking about Alberta and seeing where it was going, and we were actually saying to our community as well as our investors, pay attention to what's happening in Alberta, particularly Calgary at that point. And then when COVID hit, we saw that churn start to pick up, and we knew that Alberta was going to be very strong. We said Calgary was going to be one of those areas that really hit it out of the park. Well, why was that? Because economically, we saw the shift in oil and gas, number one. Number two, we saw the leadership shift in terms of what they were doing with the province and diversification of what they were bringing into the province. But here's a fundamental thing. Housing was very inexpensive at a time when everywhere else it seemed in the country was getting really expensive. The cost of living, lower cost of living in Canada, no HST, no PST. And then the cost of business. So what was happening is we saw businesses even going into the province. And well, what does that mean? It means, well, guess what? They're going there because they can do business. Number two, that it's the cost of business is lower, which meant that they were attracting jobs. So this is all to say that in an overview, we see what's happening in Alberta. Provincially, they're very strong economically. We're seeing huge immigration into that province, and interprovincial migration as well. So we've been pounding this drum, if you will, for 3 years, and now all of a sudden it's coming into people's awareness. Now, this is all to say that the economic fundamentals that we watch, that we share with the community, this is just kind of, we told you so, because it wasn't that we have a crystal ball. It's just that when you look at these economic fundamentals, the drivers and the influencers, you can start to see how things are going to unfold. People who got in 2 and 3 years ago are pretty happy. Now, of course, many are getting into that market, that Alberta market, still very strong, still has a good future in terms of the real estate. We'll be paying attention.
Now, by the way, you told me earlier this week you're no good at monologues, but let me tell you, you just got to talk about Alberta, and you're very good at monologues. I mean, that was a hell of a monologue right there. I couldn't even get a breath in there. If it was thank you for that rant, Mr. Alberta. That has nothing to do with the conversation we're having, because I asked you about a recession, and then you went into your Mr. Alberta monologue.
Well, okay,
now let me ask you the next question. Before we go on to the recession, we got to ask the next question. Are you on the province's payroll? Just check it. Just full disclosure. No?
Either tell me the truth or shut up.
No, and all I want to do is share with our listeners, our community, that Alberta is a very strong economic.
Listen, I'm not saying, dude, you're right. I listened to you. I moved some of my portfolio to Alberta and I've doubled my money in the last 18 months. So I tell everyone you're right.
Hey,
but you're still Mr. Alberta.
Yeah, okay. All I want how are you rewarding me for that information, by the way?
Just my friendship is reward enough.
Okay, so the point is this, back to the conversation about recession, no recession.
Thank you.
Okay, so JG, one of the things that we didn't get into in enough detail, I don't think today, but we can now look at all these points that we covered. And one of the risks that are happening that we have to pay attention to, that the Bank of Canada is going to pay attention to, and that is the employment numbers. Right now, we've got record low unemployment, which I've said many times is not healthy. But if we start to see unemployment tick up, and my magic number is 6%, and that's just based on a lot of years of experience, and I know that 6% is still a healthy number. But we start ticking up over that number, and we're going to start to see some real fears around a bigger recession happening. Now, the thing about employment is it doesn't seem to tick up slowly. It all of a sudden it starts and then goes boom, and you start to see a real spike in unemployment. The thing that we have to consider is when we talk about commercial real estate, for example, and what happens as the buildings aren't filling up, what does that mean to the businesses that are needing those people to come into them? Well, they start to slow down. People not spending money, those things start to slow down. So when we look at the unemployment numbers into the future, if we start to see them go up, the Bank of Canada will actually back off on that rate increase. They will not do another real rate increase. Having said that, if we don't see that unemployment number start to tick up, then we'll probably see another quarter point, is what I think TIF is going to have to do to try and keep things under control. Point is this: rates go up, people spend less money. I expect unemployment to start to tick up. That whole monologue, what you call a rant, is really to say this, is that Alberta is positioned very well into the future. And I don't see a recession. I think Alberta will be the economic engine for Canada in a big way over the next year or two for sure. And as much as we're seeing oil prices come down, I'm sorry, we can't step over the fact that we got a geopolitical, a macro of what's going on, Ukraine, Russia. It feels like that's a repeat all the time. But guess what? Things are actually escalating over there. Not good news, but I'm very, very confident that we're going to see oil prices go up. I just can't see how it is. When you do the math, you got China coming back online, so their demand for oil is going to be much higher. There's lots of things that are happening in behind the scenes that only speaks for the price of oil and natural gas increasing into the future. Right now, things are down. Let's take advantage of it. But when we look into the future, I don't think it's going to stay there.
Now, you and I both have a plane to catch, so we can't afford any more Alberta monologues, by the way. But I still don't have an answer to the recession, because it was like, I don't know, maybe 6 months ago, Patrick, I remember these exact words coming out of your mouth, which first come out of your mind and then come out of your mouth, which is, I don't see a way we're not going to go into recession, is what you said 6 months ago. So where are you at? Now, things change. And listen, I'm not saying that things don't change. Things have changed. So given the stance today and given the data we have in front of us today, where are you at with that?
Well, so right now I'm on the page where I'm concerned about Ontario. I think that they could, in fact, get into negative GDP growth by kind of mid to third quarter of this year. It could go there based on the data that I'm seeing. And so in terms of, I always said I don't see the data going into a recession, but now as the more data comes in, I'm going, when we look at it from a provincial perspective, I see Ontario at risk. I see the Western provinces not so much.
Beautiful. Recession covered. We're going to dig into that on the next episode a little bit more. Yeah. Not bad. Good shot again.
Oh, but I want to point out one thing about that recession on Ontario.
Oh, here we go. Another friggin' Alberta monologue.
No, not at all. I just want to share with listeners is that one of the things that we look at when you go into when you have Ontario with the population it has a big impact on the rest of the country, and it has a big impact economically. So as much as Alberta is over 4 million people, and it's driving a lot of revenue, a lot of tax revenue into the general coffers, Ontario being upside down is not a good thing given the population.
So you're saying it's actually Ontario driving Alberta?
No, Ontario is going to support Ontario. Alberta will support Ontario, as they often do.
Next topic is immigration, Patrick. Now, you often go into Alberta monologues, which we see too often for my liking, but anyways, and that's very much driven by immigration right now, Patrick. Alberta is killing it in terms of in-migration from other provinces, which hasn't been the case, by the way. I mean, it's really happening now, but if you looked at the stats from 2015 to 2020, I think it was, I mean, people were leaving Alberta in droves, but now finally people are going back to Alberta. And this isn't a conversation about Alberta, but just immigration in general is really driving the real estate market. And in fact, a big part of Canada's economy is all the people that are coming into the country from immigration. And then once they come to the country, most, by the way, through Toronto, i.e. Ontario, a little bit through Montreal, a little bit through Calgary, but mostly through Toronto, then they go through the rest of the country, which then counts for in-migration, correct?
Well, yeah, you got immigration that actually comes in Toronto, Montreal, Vancouver. Those are the three primary centers. Mm-hmm. And then they kind of dissipate over there depending on what's going on, where the jobs are. And as much as you tease me and kind of give me the gears about being Mr. Alberta, you said something that even in this part that really rings true to what we've said before. When Alberta's economy was down, what happened? People left that province in droves. They actually moved to other parts of Canada, primarily Ontario, by the way, because why? Because the economy in Ontario was very, very strong. What's happening in Ontario is that as things, and it's mostly the cost of living in Ontario that is having people move out of that province. And the thing is that Alberta right now is the province to be in when it comes to having a job and being able to afford a place to live and or just afford a lifestyle in general. So if that were to shift and go back to Ontario, then we'd be talking a lot more about Ontario. The thing that we have to look at with immigration, aside from the pressure that it puts on housing, and it does, certainly from an investor point of view, there will still be a demand for rental housing. So as investors, we always want to be paying attention to where are clients at. Number one, is there lots of clients coming in, lots of tenants coming in? Do they have income? Can they afford the rents that we need to charge given the cost of housing? These are all things that we need to consider. So immigration coming into the province from a housing point of view puts pressure on it. But as an investor, that's actually a good thing. Having said that, where we really are feeling the pain is in our infrastructure, primarily healthcare, and that's something that we can't ignore. And that is also some of what will drive costs provincially: more debt, more deficit. So these are all things that there's, like I say, a lot of moving parts to it, but these are things that we have to pay attention to. And immigration, we need it, we want it for all the reasons that we have, including jobs that we need to fill.
I want to ask our viewers something, Patrick, but I want to ask you as well. Folks, put in the comments below. I want to find out, I know pre-COVID, one of the hottest real estate tactic out there was student housing, at least where I am around my various regions that I invest in. And I think across the country, there was so many students coming to study in Canada. It was an incredible tactic. A lot of people were buying single family, dividing up the rooms and then renting out each room. And there's a variety of ways to run that. I don't like that particular tactic. It doesn't work for my portfolio. I don't play that game, but it was a very, very common tactic. And it became the hot thing. It was driving up the price of single family because when you divide up every single room and you start renting every room for $700, you can overpay for a single family. In my markets, this was happening. Then COVID hit, that whole thing got washed out. And the smart investors, which you and I consulted many of them on, we told them you should flip your properties to duplexes, find a way to retool that property because student rentals aren't going to be a thing for a couple of years. COVID then happened, and now that international student population has really come back. Is it, number one question, Patrick, for you is, do you know the numbers, and is it as high or higher than it was pre-COVID is the first question. But I want to find out is that still a hot topic, like a hot tactic that people are doing a lot of? And the viewers, I'm curious what they think as well. So put in the comments below. But the question's for you, Patrick. Is that still hot? I don't hear it as much nearly as I was 3 years ago.
Yeah, and that's a good point. I don't know the exact numbers. I know that international students are still very strong, if not stronger than pre-COVID, and that there's still definitely a demand and a market for it. The problem is actually, again, a supply. And you're hearing lots of anecdotal information, anecdotal conversations about international students who are living in the slums. I mean, they're paying ridiculous amounts of money for a bedroom that, with no bathroom, or a bathroom way down the hallway that's shared with 7 other people. So the cost for international students to finding a place to live still remains a huge topic. It isn't mainstream media so much, but there is definitely an underlying topic or an underlying conversation that the international students are very much struggling, and probably students in general, period, international or not.
But you're not sure from an investment tactic if it's as hot as it was. You're not sure. I'm not hearing about it nearly as much as I was. I mean, it was like it dominated just about every third conversation I had in 2019, 2020 was like, how do I buy this house and how do I convert it into a student rental? Everybody wanted to do that. They don't ask me that question anymore, Patrick, because I'm curious to see if people have retooled their properties permanently and if that tactic has gone down in popularity. That's my curiosity.
Yeah, well, I'd have to look at the data, and I know it's out there somewhere. I haven't seen it recently. To your point, it seems quieter, but it's definitely still a very viable tactic.
Immigration, student migration, international student population, all those topics covered. All right, Patrick, next topic is commercial vacancy. Now, we got some charts on this, Patrick. Very, very interesting, because when COVID first happened, one of the big topics you and I brought up right away is commercial real estate may never be the same after COVID. And kind of, we didn't, quite frankly, well, I'll speak for myself, I didn't necessarily know how it was all going to shake down, but I just knew that kind of shakeup where every office tower gets shut down, every commercial real estate space gets shut down, and people are forced to adapt and work from home. My gosh, that has a profound impact. But now we're starting to see some data, Patrick. So what does the data show? And interesting to see where this is going to go as well.
Well, this is back to this covers a lot of things when we look at what's happening economically and some of the risks that are underlying. And I think that I think the actual numbers are that we're back to about 42% of vacant or of
42%. Toronto. The headline says Toronto offices now at 42% of their pre-COVID occupancy.
Yes. So,
but that means they're still down by more than half.
By more than half. This is where there's a lot of things that if you just look at that headline for what it is which means, oh, holy cow, offices aren't getting filled back up again. Now that's true. We've said time and time again since COVID is that work from home, work from anywhere, that was going to continue to be a thing. Now there's some businesses that they have all of their staff coming in, but that isn't actually the norm. They're working partial days. There's a hybrid of people coming in. They're just not going to commute anymore. People have taken a stand. So if they can work from home, they're choosing to work from home and they're pushing back hard. Well, what does that mean? It means that all of these businesses that had big offices aren't filling. So the actual forecast and the conversation that we are having over this course of time, which was work from anywhere, work from home, means a lot economically, because these downtown office buildings, there was a lot of businesses that relied on that traffic. And I'll just use a food court as an example. If you see some of the articles that are showing up, is the food courts were really struggling. A lot of small retailers that were set up downtown in incredibly expensive space requires and needs that office traffic, that personnel from those offices coming in to spend money, and they're not. So the economic ripple effect in a downtown core is very meaningful. Now, having said that, you've also got individuals who, when it goes back to the real estate, these peripheral, more or less expensive housing in these peripheral towns, for example, as you go outside of the CMA, these are markets that continue to gain strength. So maybe there'll be a balance, but let's put it this way. There's a lot of empty space in downtown cores. And that is really right across the country. And this will continue. I don't know what they're going to do with it, to be honest with you. We got to keep an eye on it. But economically, can really affect those cores.
There's no doubt that space is going to be in transition for a long time to come. And by the way, that was a Toronto headline. Fascinating. The headlines in San Francisco are way more depressing than that. I mean, Toronto's rebounded quite well if you compare it to other major metropolitan centers. Yeah. And there are some commercial sectors, like San Francisco as an example, that are in total chaos. And I think that and we called this right from the beginning, Patrick, again, don't know where it's all going to go, but that whole space needs to re-engineer. The same way, and if investors are asking themselves, well, what does that look like? Here's a vision that you can kind of appreciate. Every little strip plaza that was built in the 50s and 60s and 70s has had to re-engineer themselves, Patrick, in the last 10, 15 years. We were just talking to an investor about this the other day, and some of them have done that very well. Some of them have re-engineered. They've put, cool little shops in there. Some of them have added, stories above and put in some condos. I mean, those that have retooled and those that have pivoted have done extremely well and have saved their real estate. Others got torn down. Developers bought them, tore them down, and built condo towers. That's a way to retool and pivot a space as well. And others, and you see this again in the States more than Canada, and definitely a lot more in kind of rural settings, but you see a lot of those strip plazas and stuff that are just desolate. Those investors didn't pivot. Those investors didn't retool, and they got swept into a market that needed transition, and they didn't lead the market. And that's what's going to happen to commercial owners that don't pivot with the times. There's no doubt the times have changed. Will it go back to what it was? No. Will it be something new? Yes. What is it exactly? We're not quite sure, but investors have to pivot. And this example of the commercial space is just an example, Patrick, but this happens to everyday real estate investors all the time. And it's just an important point I wanted to bring up about investors needing to pivot to match the needs of the market.
Yeah, this is something that's interesting about all of what's happened over the course of these past 3 years. There's a psychology component of it. There's a shift of attitude of people in general. Aside from the frustration, the fear, the anger that's going on, people have a different attitude about how they're going to work. Life has changed for people in terms of where their priorities are. There's a psychology component of it that is now a factor that it wasn't really a factor before. Everybody was into the groove of doing what they're doing. This was a huge disruption psychologically for people. And when we look at housing and where people want to live, how they choose to go about their day-to-day activities, what they're doing for work, where their priorities lie, that's all shifted. So I think it's really important to understand that when you're looking at this pivot, if we only are thinking about what once was without taking into consideration the emotional and psychological impact that's happening with people in general. Now that's hard to read, but I'm seeing it. I know you are. We're seeing divisiveness and wokeness, and there's a left and there's a right, and it's like there's so much polarity. And then on top of it, we add an economy and we add global issues. People are doing things different, and we would be remiss to deny that psychological and emotional shift, JG. And as investors, we have to pay attention to it and kind of look at it through a different set of filters.
Yeah, for sure. There's the positive people, and then there's the realists. I'm pointing to you.
What's real? What's real is people are messed up. That's what's real. Okay, go.
But I'll end on this note, Patrick, which is this is where opportunities are created, folks. This is where opportunities live. Anytime a market is in chaos and there's change in the market, that's where the opportunities live. And it's important for investors to look at these changes not as a bad thing, but as an opportunity. If you want to get into those markets, this is where those opportunities live. So you have to look at it with that lens, which is a positive lens, Patrick, one that I bring to the show.
Well, understand one fundamental thing. I'm not making any of it wrong. What I'm saying is that as investors, the opportunities live in understanding that there's been a shift. Denying that shift or ignoring it will cost you a lot of money. And if you really do look at it through a different set of filters and start to kind of weigh through all of the things that are happening, that's where you will make a lot of money.
I'm just saying that, you always laugh at my rose-colored glasses, but that's the topic on commercial vacancy. Check covered. All right, Patrick, let's talk about the GTA and Toronto specifically, and the speculators that are finally getting washed out of the market. We called this, Patrick, we called this when COVID first happened and we started seeing the market really take off. We told people, listen, be very careful. There's no economic fundamentals supporting this. It's all driven by the influences of low interest rates. So be very careful and make sure you make wise moves. Don't speculate, invest. And some people took that wisely and made the most incredible investments they ever made. Other people, Patrick, didn't necessarily listen. They went out, they speculated on a pre-construction condo that was going to appreciate forever. And now the hen has come home to roost. Is that the saying? Is that how you say it? Anyways, I'm French. I don't know these sayings, but something came home to roost, and that is interest rates have gone up. They can't afford the mortgages. They can't get qualified for the mortgages. They have to sell their condos. They can't assign them. There's no buyers out there, and it's a shit show for some people.
Yeah, this is something that people got caught up in the FOMO, no doubt about it. But let's look at what was, which is they had a good 10-year run. I mean, there was a lot of that stuff that was being done over the past 10 years, and people were getting away with it. Lots of people made a ton of money in that market. But you started to see the kind of the peak of the market. We got to this crescendo of people, the FOMO, and it goes back to the old story, right? When the cab driver looks around and says, I'm going to quit, I've been investing in real estate and I'm making hundreds of thousands of dollars. My cab's just a side hustle to my real estate. Then nothing against cab drivers. I'm just using that as an old tale that says that when it gets down to that kind of level of people that are buying $1 million condos and they're, an Uber driver, there's lots of stories around that. Then you start to realize that things aren't quite right. And this is people getting in on the FOMO side of it. Now, what does this mean? You and I were just in Toronto. We met with many of Ontario's top realtors. I mean, the 1% of the 1%. And, we start to get and gain a lot of insights into what's happening. And part of what's happening in behind the scenes is that there were people that bought, let's say 5 years ago, who are now having to get mortgages on condos. They're probably doing okay because they've had this big lift. And, even with the increase in interest rates, they're fine. But then there's those individuals who bought, let's say 2-3 years ago, where some of those things are coming online and they're having to get mortgages. Well, guess what? They're not going to appraise. So they've got a problem with that. Secondly, the interest rates are higher. They never intended to actually take possession of those properties because they wouldn't qualify for a mortgage. And now they have no one that wants to assign them or to buy them from them. And we have a whole set of problems. Now, the point of all of these kind of things, there's different scenarios. There's probably 4 or 5 different scenarios. But the point is that some are starting to come to roost now. We're starting to hear about it. And we have not seen anything yet. The conversation in the next 6 months, the next 12 months is going to be crazy, I believe, with the fallout of those individuals who bought that pre-construction game, whether it be condo or townhouses or even detached, and weren't really prepared to step up and qualify for a mortgage, don't have the money. Now what happens when those properties, by the way, they buy something for 1.6 million, it now appraises at 1.2 million. So where are they going to come up with that difference? So these are all things that have not yet played out. We're just starting to see it. Goes back to what we said many times. This is a huge opportunity for investors who are patient, who want to go in and solve problems. There's going to be all sorts of deals to be had if you're educated and you're surrounding yourself with, investor-focused realtors, for example, and investor-focused mortgage brokers who can help you kind of create those opportunities.
I think, Patrick, what's interesting about this is that, and I want to be very clear, folks, we're not saying condo investments don't work. That's not what we're saying. But condo, if your tactic is to buy a condo pre-construction, by the way, condo is a tactic. It's actually an asset class. Pre-construction is a tactic. Assignment is a tactic. And when you combine those 3 things, condo, pre-construction, and assignment, you have to match that tactic to the real estate cycle very, very closely. And when the cycle shifts, like it has when it goes from boom to slump, which it has, this is where people get caught. And by the way, Patrick, we're using this as an example, but if you purchased a property to fix and flip at the end of the boom and it changed over to the slump, which it has, you're in the same boat. You're in a position where you don't have a very good fix and flip deal anymore. So we're not picking on condos. We're not picking on pre-construction. We're not picking on assignments. All of those are fantastic tactics when they're matched up to the real estate cycle, which is the research we spend so much time doing, Patrick. And that's what's important about this conversation.
It is, and we talk about it often. We use the kind of the analogy of musical chairs. It's all great until the music stops and there's no chairs left. And a lot of people are getting caught. The music has stopped, and now there is no chair, and they are scrambling to figure out how they're going to close on deals, how they're going to finance deals. Like it really is messy out there. And we'll see how that all plays out. But as I said earlier, there's still lots of lag that's going to get caught up later on in the system.
GTA Toronto speculators getting washed out. Topic covered, and probably a topic, Patrick, that we're going to talk about again and again and again, because like you said, there's going to be a lag. We're going to expect more of this, but does present a huge opportunity for the right investor at the right place at the right time, looking to help and solve a problem.
That's really going to be an important part of any investor strategy going forward. How do I solve problems? Making sure you got the right people on your team.
Well, that's exactly, so this is exactly what we're going to cover at our upcoming R4 conference, Patrick, where we talk about regions, we talk about rates, we talk about, where is the cycle at, but also what tactic works right now, because as you and I often say, and hopefully one day we become famous for saying it, Patrick, because it's so true, is there's never a bad market and there's never a bad tactic, but you have to match the right market to the right tactic in the right part of the cycle in order to be successful in real estate. That's what we're going to talk about at the upcoming R4 conference, February 24th and 25th.
And we're going to have a bunch more data. What we didn't dig into here, and is really the conversation around employment and what does the future employment look like. And I think we have to touch on that. We'll actually have more data on that when we have that conference. It's an important conversation to have, and we can look forward to sharing those numbers with the attendees.
Love it. Sign up for the R4 conference. Tickets, I think, are maybe still on early bird or early bird pricing, but the price is going up really soon. So you want to check that out. We're going to put the link in the description below. So click that, get signed up, and we're going to see you at the upcoming R4 conference, February 24th and 25th.